Welcome back to the Hairdresser Strong News, and what does it have to do with you? Today's news is all about a massive amount of economic data has come in, and we've also had the Federal Reserve speak, and what did they all say, and what does it all mean? I will be going through the data with you today. So what is that data? We have the CPI, or the Consumer Price Index, which is what you pay. We have the Producer Price Index, which is what producers pay, people who create and produce the goods that you buy. We also had employment data, so like what job, how many jobs are created, how many people are employed, how many people are unemployed. And also, we have interest rates. The Federal Reserve has spoken on what they're going to do with interest rates. Why is this important? Well, simply, if you want to expand your business, make a large investment, then interest rates are important. If you want to sell your home or sell your business, interest rates are really important. Knowing whether or not your customers are interest rate sensitive could have a huge impact on your ability to provide services to them. Okay, and last but not least, politics play into economies, or do they? An election year creates a ton of uncertainty, and I'll be deciphering from multiple resources how you should prepare yourself for the upcoming election. And no, I don't care who you're voting for, because this is business, baby. All right, let's dive right in. I'm going to share your screen, and you can follow along if you're on on listening on podcast, and there will be some videos to play. All right, let me just pull this up. All right, here we go. Okay, so what we're looking at right now is an article by Jeff Cox on CNBC. This was posted about 5 days ago, and the title is Inflation Slows in May with Consumer Prices Up 3.3% from a year ago. Okay, so the consumer price index held flat in May, though it increased 3.3% a year ago. Excluding volatile food and energy prices, core CPI increased 0.2% of the month and 3.4% from a year ago. When measuring consumer prices, the Fed looks at core CPI, which excludes food and energy, which you might think is kind of crazy, because how important is food and energy? I mean, think about it. If it's the summer and you need AC, or you got to drive your car around from place to place, seems really important. Well, there's also, you'll see down here, when we get down here, we got two numbers. I'm looking currently at the US Consumer Price Index from 2021 to 2024, and you can see here, and if you're listening, I'll explain it to you. Consumer prices, what we pay for things, has gone up significantly from January 21st all the way to a peak around June of 2022. And since June of 2022, all items, including food and energy, have been coming down significantly and seem to really plunge for a year straight, from June 2022 to June 2023. Well, from June 2023, which is last year, till now, which is now, no real change. If anything, it's up a little bit. So what that looks like, though, is some sort of normalization over the course of year of inflation not being volatile, not going up, but not really coming down. Ultimately, though, this was better than expectations. So the market saw this as a good sign. And so let's move into job openings. So job openings came out. This article is on Reuters by Ann Saphir, and it is on June 4th, so just over 2 weeks ago. So U.S. job openings drop in April as labor market normalizes. U.S. job openings fell more than expected in April, publishing the number of available jobs per job seeker to its lowest in nearly 3 years, as labor market conditions soften in a manner that could help the Federal Reserve fight inflation. So at first initial thought, job openings are falling. That might sound like a bad thing at first. However, if I come down here, this explains that there are 1.24 jobs available per unemployed person. However, during the post-pandemic peak, there were almost 2 jobs for every person. So that was when we saw the Great Resignation, and a lot of extreme wage inflation. So you saw wages go up significantly. like I said, this is not about opinions. This, you might think that wages should have gone up because they were low. That's not what I'm talking about. What my opinion on what they should be. I'm just talking about what they are doing and what the implications are for them, and trying to always relate it back to your life, your business, and your customer. Okay, so having less job openings per unemployed person means two things. One, if you're looking for work, it means the job market is getting tighter. It means that it also it means more than two things. It means that if you have a job, you're most likely not going to jump from job to job, looking for more pay or greener pastures. It means that you might be trying to work with where you're at, trying to improve conditions if you feel like they need improving, or just in generally, you're going to be less likely to switch jobs if this continues, if the labor market gets tighter. Now, if you're a job provider, if you're looking at hiring somebody, then you are saying, well, it's going to be a little bit easier to hire somebody. You're not going to have as many applicants coming in and no showing you or ghosting you or whatever. I had 80% of applicants coming in from Indeed no show me or cancel last minute, and that number is going lower. So people are not taking this job that we have to offer for granted and thinking they can just hold out for something better. So whether or not you think that's a good thing or bad thing, the Federal Reserve thinks it's a good thing. That means that market conditions are normalizing. We don't want a ton of job openings. That creates other problems. Okay, so U.S. Producer Price Index, it unexpectedly fell in May. It fell amid lower energy costs, an indication that inflation was subsiding. So this is a really positive thing. That means that consumer prices go up when the producer prices go up. Could the producers have to cover their costs? They might absorb increased costs if they're small, so that consumers don't have to pay for it. However, that doesn't typically happen for long periods of time, and the producers will only absorb prices if it's a small amount. So seeing prices fall for producers is a positive thing for inflation over a period of time. So now I want to play this CBS News. It's about a minute and a half, 2 minutes. Under 2 minutes. This came out 4 days ago, and the title is "Inflation Eases Slightly as Fed Leaves Interest Rates Unchanged." So, kind of going back, so ultimately, everything I'm saying is positive overall for the macro environment, which is like, just think of the whole country. The whole country seems to be going in a positive direction. Now, I'm going to tell you why, when you throw in politics and election year, how listening to the news and hearing positive news might not actually uh, be as impactful as what people are experiencing on a day-to-day basis. Emotion, just always remember that psychology and emotion moves markets in the short term. So if you have short-term goals, then understanding the emotions in the market and the psychology of market participants, which are employees, employers, investors, regulators, legislators, etc. Well, you might want to know this. Now, if you're listening over the long term, if you're thinking about long-term view and you're not worried about short-term economic movements right now, then good for you. I have some news for you as well. Okay, so check this out.
The Federal Reserve did not change its benchmark interest rate on Wednesday. It will stay between 5.25% and 5.5%. That range, the highest in more than 2 decades, has been the same since July of 2023, part of 11 rate increases over the last 2 years, meant to slow economic growth to bring down inflation. Though Fed officials entered the year thinking inflation had been tamed sufficiently to warrant 3 interest rate reductions, data this year cured them of that optimism. Federal Reserve Chair Jerome Powell predicted only 1 rate cut this year, saying, quote, "The economic outlook is uncertain. We remain highly attentive to inflation risks."
Okay, so this is the stark contrast to the beginning of the year. The beginning of the year, they're all like, "Oh yeah, we're gonna have like multiple rate cuts. Everything is good and gravy now, and you don't worry, we're gonna ease things up so you can sell that house, or you can buy that house, or you can expand your business, or hire more people, or buy that new machinery, or whatever." that you are wanting to do or your customers are wanting to do. Well, until that happens, money feels like it's tight. Spending is a little tight, which means we need to be focusing on value with our customers. And yeah, so keep going. Let's keep going.
Also on Wednesday, the Labor Department says inflation rose to 3.3% since last year. That's lower than expected and down from April. For more on this, let's bring in Ben Castleman. He's an economy reporter for the New York Times. Ben, good to see you again. Let's start with inflation before we get to the Fed. What do you make of this inflation report, and how do you think the Fed sees it?
I mean, look, this was unequivocally good news that we got today. Uh, Consumer prices didn't rise at all in May compared to April. They were up 3.3% from a year earlier. This was clearly progress. It was better than economists had forecast. It comes after several months of not so good news, right? And so the Fed is certainly being cautious. It doesn't want to declare victory here. But they've been saying that they want to see clear evidence that we're moving back towards this 2% target for inflation. And today's data was certainly a step in that direction.
Right. So while it started off like positive, good gravy's coming, things got a little weird and uncertain, and the Fed has pulled that language back, saying it's all good. We're going to be able to like loosen up monetary conditions, and however, that changed. That changed. The numbers came in hot, so the Federal Reserve had to pivot and say, actually, maybe got a little ahead of ourselves. So there's also a lot of conversation about when the Federal Reserve says positive times are coming, the economy will heat up because the markets are forward looking. So if the Federal Reserve says good times are going, it does make sense that markets move upwards, which could also lead to inflation worry concern things that worry the Federal Reserve on inflation. So there's a psychology thing for you as well. Now, that said, fast forward to what are the economic data that's coming out now says that things are improving again. So it was like good, and then it was worrisome, and then it's good. But ultimately, that just leads to general uncertainty. So that leads me to politics. So now I have found this thing from Fidelity, and it's called the Election and Markets, 5 takeaways. With more certainty about the race, here's how stocks could react to the 2024 matchup. I don't know about more certainty to the race. The presidential race doesn't seem certain at all. I don't know if you feel that way, but here we go. Here's your key takeaways and things you need to know about during an election year. I have some information from JP Morgan about this as well. So let's start here. Historically, US markets have generally risen in election year. This says from the 50s, the prices averaged somewhere around 9% returns in an election year. However, JP Morgan.com in their piece that says 3 election year myths debunked. Myth number one is that stocks don't do well in election year. But I guess Fidelity is saying 9% return is good. That's pretty good. So we're not saying, I guess they're saying the same thing, that if you think 9% is good, except for JP Morgan says from 1928 to 2023. So it's not from 1950 to now, it's from a little longer period of time. So maybe that's why the average is lower, because in 1928 we had from between 28 and 50. Let's see, when was the Great Depression? So economic times 29 to 39. So depending on how you collect data is going to help you determine what the data shows. And there's a whole other conversation about data, but let's just continue on here. Okay, so going back to Fidelity, Fidelity says, okay, number two, down ballot races may be highly consequential, and I'll explain that in a second. And number three, betting on specific policy or sector impacts can be highly risky. So betting on specific policy or sector impacts would be like, I think that the Democrats are going to be coming in, or this president, or the Republican president's going to win, and so they're going to go for this policy. So I'm going to invest according to that. Now that's a short-term move. You're betting on psychology and emotions for something that is harder to predict, because like this one says, down ballot races may be highly consequential. So if what has been normal is something called ticket splitting, where a lot of people will vote for, say, a Democratic president but a Republican senator, or a Republican president and Democratic senator to create balance. However, that ticket splitting is becoming more and more and more rare. So that just leads to uncertainty investing based on an outcome of an election. So basically, I guess I would surmise that you just should not bet on the outcome of an election. So here's another piece to know: markets are nonpartisan. Although popular myths sometimes suggest that one party is better than the other, historical data does not say that. As a matter of fact, I just saw data that came out that said Wall Street finds more uncertainty with the current Republican candidate than they do with the Democratic candidate. And as long as I've been paying attention, then typically Wall Street is more happy with the Republican candidate. So that just goes to show that that markets are nonpartisan. So you need to leave your opinions and emotions kind of at the door when you're making financial and business decisions. However, like I say, in the short term, emotions rule everything. But over the long term, it's all about value. It's all about serving your customer. It's all about delivering value to people who want to pay you for that value. Okay, and last but not least, kind of goes back to what I'm saying. Investors should focus on fundamentals and stick to with their plans. Now, this is Fidelity. Remember, I am not licensed to give financial advice. So if you want financial accounting or legal advice, that's a financial planner, CPA license, like a certified public accountant, and a financial advisor. So financial advisor, lawyer, if you want legal advice. Okay. I'm not a financial legal advisor, legal consultant, lawyer, accountant, any of that. All right. So I'm just aggregating all this news so that you can go off and do your own research. All right. So historically, financial markets have been largely unbothered by both presidential and midterm elections, and trying to adjust your investment strategy in the term in hopes of capitalizing on anticipated post-election swing in the markets could end up backfiring on you. If you're an investor, I would suggest that this shouldn't be something you focus on. So let's see what JP Morgan says. All right. So JP Morgan says myth number one is basically the election year results, they don't matter, is basically what they're saying. Number two, markets will crash if a specific candidate gets in. If you hear anyone saying that, just know that they're just selling you fear to get you to vote for them. And I don't know if anyone is, so I'm not trying to say that I know. That's not like some backhanded way of trying to tell you to not listen to the person that you're. Anyway, I'm not trying to be political at all. I'm just reporting business and financial news in the midst of an election year. And this is interesting. I see since 1984, I'm looking at a graph that shows the S&P 500 up until election day. This shows that from an election onward, majority of the time within a year, the markets are doing better than on the day of the election. That's just the majority, and that's only since 1984. I don't know what the massive historic election is, but something else to remember: while short-term moves in the market are based on psychology and emotion, long-term is based on fundamental value. Uh, That also goes into like data. Data is all about perspective. Like if you change the data to include more variables or different variables or expand it over a longer period of time, it could tell you a different story. And economists have been doing it, and it's considered acceptable behavior, especially at the academic level, to pick your data to like data sets are picked according to what you're studying or what type of outcome or etc. So just make sure that you understand what data you're consuming. And that's why I always like to try to bring up, like, how did you come up with this data? I just showed you data from 1928 till now. Then I showed you data from 1950 to now, and I showed you data from 1984 to now. Each one of those is going to tell you a different story. Myth number three: the Federal Reserve doesn't change policy in election years. So the reality is that the Fed hasn't shied away from hiking or cutting rates during election years, but they don't want to be seen as politicized because they don't want to lose credibility. Because the second they lose credibility, then they lose their ability to maintain power and control over markets. Okay, so how do you plan for the year ahead? According to JP Morgan, they say the same thing that everything seems to be pointing to is when politics convoke strong emotions, we don't think you should lose sight of your long-term strategy. We believe the economy will remain the predominant driver of policy decisions and market markets broadly. Of course, there are risks from ongoing friction points such as inflation to wild cards such as geopolitics. We don't know if the Ukraine thing is going to go escalate. We don't know if the situation in the Middle East is going to escalate. We don't know if Taiwan and China thing is going to escalate. So, out card of wild cards, or also called black swan events, um, focusing on the long term seems to be, and even in that case, it seems to be the thing that you can focus on. So long term, you should be bringing value to your customers. Long term, you should be focusing on your customer experience. So in a higher interest rate, credit tight market, it might make sense to make investments in places that don't require a large amount of dollars, but maybe more of our time. And that looks like auditing our customers' experience from the time how they discover us, and then their pathway to coming into our chair, and then how we communicate with them afterwards. Technology is a great thing to use for that. There's lots of applications, lots of software. There's even AI you can play with. But if you're interested in a digital customer audit, like your customer's experience audit before they even come into the salon, making sure that your Instagram and your TikTok or your website and your everything is has all the information that can have, you can shoot us a message at listen@hairdresserstrong.com and request the digital customer experience audit that we dropped at our annual conference that we host here in DC. That is something that you can use. Okay. Yes, that was a plug for you for some resource that we have to offer, but I'm not trying to sell it to you. Okay, so I have another article. This article is about a month old. So you can see inflation continues to ease. There's still some uncertainty over the election. There's uncertainty over geopolitical stuff, but things do seem to be going in the right direction. Now I'm looking at generally this is saying that consumer prices are coming down. Wage inflation is coming down, which means that this is all normalization of markets. Now, here you go. Fed officials started the year optimistic, like we mentioned that before, but a string of hot data upended the policy projections from Washington to Wall Street. Some economists and Democrats fear keeping interest rates at their highest level in more than 2 decades could weaken job growth and tip the economy. Fed officials did not expect this to be a smooth road, but first quarter inflation readings were higher than anybody expected. And what that has told us is that we'll need to be patient and let the policy work out. That just means there's continued uncertainty. We don't know exactly what's happening. So in the midst of uncertainty, we listen to Fidelity, we listen to JP Morgan, we listen to basically we kind of look for stuff in what we should be doing, and that is focusing on delivering value, making sure that you understand how to communicate with your customers who may be having tighter financial situations and how you could accommodate them without sacrificing your business. And so here you go. Here's something in how to market in a downturn. This is old. This is from 2009. However, the advice is timeless. Companies need to understand this is understanding a recession. Just in the event that this uncertainty does not continue to, if uncertainty goes away and we continue to see better and better economic stuff over time, then then great. In the event that we see something give and the market does give, and the Federal Reserve has to respond to poor economic conditions with lowering rates, that might feel like a positive thing, but what are those economic situations that are going to impact us and our business and our customers? Well, this is a definition and something you should understand about recession. According to the Harvard Business Review, companies need to understand the evolving consumption patterns and fine tune their strategies accordingly. During recessions, of course, consumers set stricter priorities and reduce their spending. As sales start to drop, businesses typically cut costs, reduce prices, and postpone new investments. Does this all sound familiar? It should, because I'm kind of saying the same thing over and over again, but I'm not necessarily picking my news to cater to the narrative. This is the news, and I'm addressing all of the narratives, and they all seem to point to this kind of longer term perspective, but with a little preparedness. So let's go into preparedness. So this is from Forbes. This is also How do elections affect the stock market? Now, something I want to mention about the stock market and watching the news, people who have investments, people who are from higher incomes or families with higher money and more privilege, or people who are in general like geographic areas or in markets that are going to do better than others, they may feel that the markets an economy is doing good because it's reflected in their customers. Maybe they're serving a customer in a demographic that has more means, which means that they haven't necessarily slowed down their spending yet. However, I want to bring up a really important point. Inflation has increased cost of what we spend at the grocery store by about 25% since 2020. Adding to the uncertainty of elections is this news that the economy is doing better, excuse me, than when than is doing good. So some news is saying positive stuff, but the reality is when you go into the grocery store, you're paying 25% more than you were only a handful of years ago. And I think we can all agree that there's a time warp from COVID that's created that makes everything since COVID feel like a very short period of time. Like it doesn't feel like it's been 4 years for many people. And remember, psychology and emotions move markets. And then when you add in election year, which is super psychological, super emotional, all these variables are important. Do not forget that there's a lot of people that walk into grocery stores and then they're used to spending $100 a week on groceries. Now they're spending $125 a week on groceries. Now that $125, the longer it goes on and we have low inflation, that means that over time that increase of prices is going to feel less. However, it just so happens that we are an election year, which adds to the uncertainty. So now that I've said that, this is some advice from Forbes. Um, diversify your portfolio. Having a diversified portfolio is always important, but it's especially crucial during periods of volatility. That just means that if one sector goes down, then you don't have to lose all your money. Like if you put all your money in tech and tech all goes down, you're short. But if you have diversity in your portfolio, then you can absorb economic shocks unless the entire economy goes down. But then what are you going to do about that? Use dollar cost averaging. It's a strategy where investors invest a fixed amount of cash into an investment at regular intervals, perhaps maybe $10 a week or $20 a week or whatever what you can afford. But anything is better than nothing. And even if you think the market is high right now and it's going to drop, which is a huge narrative that's growing even greater and greater, that there's going to be a downturn in the economy post-election or leading into the election. But there's a large group of people that think that the economy is too high to invest in, and they're waiting to invest when markets come down. Why is that important to you? Well, it just means that maybe it's not important to you. Maybe just putting away $10 a week, $20 a week, $100 a week, what that does is it means that it doesn't matter if prices are high. It means that you're going to be buying with prices are low and prices are high, and over time, it's all going to even out. Focus on long-term investments. The Forbes says as the market and prices change, it can be easy to panic and make impulsive decisions with your investments or with your business or with your prices or with your customers. But it's important to remember that you're investing for long-term goals, and short-term fluctuations won't have lasting effects. So I will challenge that and say that if you're making a shift in how you invest your resources for the short term, and you're listening to this advice, invest your time in uncertainty during uncertain times so that you can bring more value. So it won't matter if the market goes up or down because your customers are still going to experiencing greater and greater value coming to you. And during times when it's right and makes sense for you and your business, raising your prices will be easier to absorb shocks, or justifying your price increases is going to be easier to absorb shock of your customers who is experiencing external factors that making it harder for them to spend money with you. Now that also depends on geography, demographics, etc. Take advantage of higher interest rates. Unless you simply can't afford it, it's a good idea to set aside cash for emergencies. And while it's smart to keep your emergency fund in liquid, accessible account, which is like liquid just means cash or something you can sell quickly, and it can be wise to move your money to high yield savings account or cash managed account instead. So basically, they're saying higher interest rates means high yield savings account. A CD is not that liquid because you might get a penalty if you try to cash it out. So high yield savings account, money market accounts, and meet with a financial advisor. Like I said earlier, I'm not a financial advisor, so none of this can be should be considered financial advice. I am sharing financial advice that I found online. But ultimately, if you want real financial advice, you should see a financial advisor. All right. Well, that basically wraps up all the financial business news. I did want to leave you with an interesting story to talk to your customers about. Human missions to Mars are in doubt after astronaut kidney shrinkage revealed. So, if you follow any tech or specifically space exploration, there's a lot of really interesting things happen, but essentially, like, we've been sending people into sending people to space, and we've been monitoring their health. Under Obama, he sent someone into space for a year, an identical twin. I'm not really sure what the latest news is on their health, but I don't know that enough time has passed to be able to say like what long-term exposure to large amounts of radiation. Just remember that radiation in space is significantly higher because they don't have the ozone layer blocking the radiation from the sun. So all this growth in space exploration is coming into doubt. However, technology, medicine, modern medicine, like, it's pretty impressive. I'm sure we'll figure out how to deal with that. However, it's an interesting conversation to have with your customer. Would they be going into space? And what type of other types of things that they have to deal with as far as part of that journey of humans onto another planet? Maybe this isn't interesting, but maybe your customer thinks it's interesting. If you find yourself in a situation where you don't know what to talk about, I just gave you something. So I'll leave you with that, and a reminder that I'm thinking about the long term. And when it comes to finance and money, I am in the camp that thinks that we're not gonna hit a soft landing. We are gonna have some sort of economic pullback, either later this year or into next year. So personally, I'm putting my money aside to hold out for that price dip for any sort of investments I want to make. I have real estate that I want to make moves with when interest rates come down. So in the meantime, I'm focusing on building things that cost me little to no money, like value in my business. We're building infrastructure to bring you services to the industry, and as well as improve the experience that customers have when they come to see me in the salon. All right, tell me what you're doing. What are you looking at? Do you see something that you disagree? Are you seeing data or news reports that you like that contradict what I'm saying that you'd like me to address? I'd love to hear, because we do not know everything. We're only products of the information that we consume. So I want to hear from you. Until then, I'll see you later.